Mortgage jargon has a lot to answer for: stress, wasted time, confusion, and money down the drain. Here are some of the worst offenders and what they really mean. Remortgage. Usually, a remortgage means switching your mortgage deal to save money. It can be one of the best ways to drastically reduce your monthly outgoings. Your mortgage will typically start with a fixed rate, usually a 2, 3, or 5-year deal. But when that period comes to an end, your lender puts you on their out-of-contract rate, which is called a standard variable rate, or SVR. This could waste you hundreds of pounds a month, up to around £3,500 a year. That's a family holiday or a year's supply of groceries. You can avoid that with a remortgage, switching to another mortgage deal just like you'd switch your energy supplier or broadband provider. Set yourself a reminder for 4 to 6 months before the end of your deal and speak to a free, impartial mortgage broker like Habito to chat about your options, which could include getting a new deal with the same lender or changing lender altogether. Standard variable rate. This is the rate your bank doesn't want you to think about. SVR is your bank's default interest rate. When your mortgage deal of 2, 3, or 5 years is up, this is the rate your lender will move you onto, unless you switch. SVR can be 2 or 3 times more expensive than the rate you were on before. The lowest 2-year fixed rate right now is 1.97%, but the average SVR rate is a whopping 4.5%. A jump in interest like that could see your monthly repayments skyrocket from one month to the next. Don't be fooled into thinking because you're paying more, you're paying off your mortgage faster. All you're doing is paying more interest to the bank. Mortgage payment holiday. Prize for the most deceptive name goes to this one. A payment holiday is not a holiday. Think of it as a payment deferral instead. Your mortgage payments are only paused during a mortgage holiday, so you still have to make those payments later, including the interest, which lenders don't stop counting. Before you take a so-called mortgage holiday, check to see how much it would cost you in the long term. A free tool like Habito's mortgage holiday calculator can help. If you can afford to keep paying off your mortgage, you might find that makes more financial sense. And don't forget to check whether you're due to remortgage, because switching could be the best way to save money in the long term. Overpaying. Overpaying sounds bad, right? But in the world of mortgages, overpaying is a good thing if you can afford to do it. In fact, it could be the best way to become mortgage-free sooner. No wonder people don't trust Jargon. Overpaying means deliberately paying more towards your mortgage to clear it faster. It's something you have to agree with your lender first, but most lenders let you overpay by around 10% of your mortgage amount each year. Doing that can knock several years off your mortgage and save you thousands of pounds in interest. Here's an example. Let's say you have a repayment mortgage of £150,000 over 25 years at 2% interest. If you overpay £100 per month, that could save you £7,302 in interest payments and shave 4 years, 2 months off the overall length of your mortgage. Take control of your mortgage. Free guides, calculators, expert advice and more at habito.com.